Hello everybody, I'm your boss, Joe Boss, and welcome to another Daily Plan. What a nothing burger that CPI was, huh? All these people, oh, that CPI was so hot this and so hot that. Look at the transportation section booming higher, and the gas and gasoline, the nat gas and the gasoline components of it going up. I'm like, those are the more volatile components of it, right? Like, that could be down in the next 1 or 2 sessions. Real quick, let me track down the tab I got open. Oh, I get some emails from the U.S. Department of Defense. Great. They're go ahead and telling me, hey, we just opened a bunch of new contracts to go ahead and award people a bunch of money for a bunch of projects. That's one good way to do research on the defense sector. Figure out who is getting some access to money and who's not, who won bids and who didn't. Yeah, I got a lot of different reports from a lot of different people. Anyways, man, just because CPI came in 10 basis points, 0.1% higher, people are saying, oh, this is so hot this and so hot that. What's interesting is when you look at the autos in the transportation sector on CPI going higher, it turns out Bloomberg actually brought on a guy who was in that industry, and he said, oh yeah, actually everything's fine. Business is booming. We're pretty cash rich. The company was Snap-on. But he said something very important, which was people are just more concerned about the uncertainty we have when we go out and get food, when we go to the grocery store, when we go and just do stuff in general, the prices are high. So it's not that this inflation is particularly harmful to the economy. It is harmful to the economy in quite a lot of different ways. But as far as economic growth goes, the rate of change of our recovery from COVID, it doesn't seem like it's going to stop it unless we get a big event like a bank goes down, or there's a new war that starts that requires more money printing. So until there's some incredibly obvious event that comes in through the door and sends the dollar higher, and goes ahead and sends the yields higher on future expected inflation, the trend right now is, yeah, inflation's going to be a bit sticky, but the economy is making progress on it. In fact, most developed countries are making good progress on it. I mean, if you go to the FX side of things, you can very clearly see, like, pound got hit a lot on CPI today. This big red candle right here. But guess what? This is a huge wick. This is 46 pip wick. CPI moved the pound all the way down here because the pound is relatively weak to the United States economically. But then all the way back up here. And then if you go across this pair, from high to low, it moved 47 pips over here. The Aussie moved 50 pips. The Euro moved about 36 pips. Like the CAD even. The CAD's pretty weak. I was just reading some analysis from RBC saying, yeah, the Canadian economy is pretty weak, but it seems like we're holding in there. This move here on CPI was 56 pips. Look, don't get me wrong, inflation on an absolute level is currently a problem, but we are making improvements on the rate of change of inflation. Inflation isn't always going to be this high, and potentially could go higher on worse events in the future. But until those bad events are actually realized, all the people, I'm getting people sending me charts saying like, oh, S&P, the S&P, this thing it's going to go all the way down to like 1,000 points. Or some guys are saying, oh, we're going to go all the way down below 5,100 here, like in the next 2 weeks. I'm like, on what? On what? The S&P is up today. The NASDAQ is up today on this quote-unquote hot inflation print. And it's not a hot inflation print. It came in at consensus. And also, be aware, all these central banks aren't just looking at headline inflation now. They're looking for a broad improvement in inflation. So that means on the core numbers, on the year over year, on the 3 month, on the 6 months, moved, sticky, non-sticky, super core. They're looking at as many measures of inflation to make sure that inflation is broadly across a bunch of different measures, moving in tandem, on trend, lower. And okay, if it's sticky for another month or two, so be it. But this wasn't a bad CPI report by any means. It just wasn't. So with that little rant out of the way, let's get into some expectations here, because this is making me a lot more bullish now when I go and I look at people saying, oh, I'm going to be taking shots, risk off, shorting the equity indices around this time, and going long the dollar. And I don't know, outside of the guys who are saying, I want to go long the yen, by the way, on Thursday, the BOJ has their blackout period starting. No one from the BOJ is going to be allowed to speak unless they have an assistant leak their commentary over the weekend to Nikkei. I wouldn't be surprised if we get another quote-unquote press test from the BOJ over the next 5 days during their blackout period. But it does seem like they're going to be hiking. And I think I mentioned dollar yen yesterday. It was, oh, we might get a pop here, and then maybe that's it, right? So I said, even if you did get a CPI that really surprised to the upside, you're not going to retrace this whole move on the yen side of things. And this CPI came in nominally, and now we've reached our expectation, right? We drew this 4 days ago, which was over here last Friday. So ahead of time, we set our expectation, and now this is the next expectation I set for last Friday. Let's see if we get that. But in this case, this is like a tail edge there. Like, is the dollar actually going to get that weak now is the real question, because a symmetric move there would be something like this sometime this month. And this is one of the reasons why I'm kind of bullish right now, net across assets on the euro dollar that I've been trading. Probably saw I took this trade here. I got this trade here. I'm still holding on to both of them. Like, not a big deal. I'm concerned about this going to this peak in the distribution where a lot of monthly highs show up. I'm concerned about it, like, trading in the mid to high 110s handle here on the euro dollar. And then we can go ahead and look at the ES. I mean, it's going into a very likely spot for a high on the month. I think we'll have sometime this week a few more green days, but we have good reason to be concerned. Like, hey, I would not be surprised if by the end of March, if things continue going well in the economy and we don't see anything actually bad print. Remember, all these guys who are saying that, oh, we're so extended and everything is so high and toppy right now. All these guys are going into bearish FOMO because they weren't long this. And so now they want to get positioned and they want to make the economy wrong for growing. So they want to try and short it. And I know some guys are going to say, "Oh, that's not what I think. I have issues with, inflation still being sticky. I have, on an absolute level, our economy still isn't growing so well. Have you seen the prices of rent and groceries?" And it's mostly inflation concerns. And then some people who consider themselves more sophisticated will bring up, "Oh, but we have all these wars starting in Ukraine and in the Red Sea and with the Houthis, right?" Look, don't get me wrong, geopolitical scenarios can move prices, but usually they are short-term volatile moments on the realization of those events when they start, when they end, or when there's major conflicts. I mean, I think the Houthis sent drones and attacked a U.S. ship some time ago. A guy actually in the trading group sent me that, and I'm like, oh, that's bad. He caught it from the SWAC on Financial Juice. I was just like, okay, that happened, and did it move the price? No. So what we actually have to see for things to roll over from here is future expectations of a bad economy actually materialize. And I think the only way we're going to get that is if a major institution collapses, like another bank collapses, vis-a-vis everything we've had over like the last 2 years, frankly. So if another situation like that occurs, I mean, even if you have a situation like that occur, you have to figure out, well, what's the extent of that bank or that institution failing? What's the extent of the damage? Because guess what? There were a bunch of banks that failed that were super huge, and they either got bailouts or they were bought out, and their economic damage was significantly mitigated. And don't get me wrong, that leaves some bad assets maybe on good companies' balance sheets, but they're good companies and they're growing. And that's how a lot of companies right now are feeling. Vis-a-vis the Snap-on guy who was on Bloomberg today, he's like, yeah, a lot of the economy is doing well, but it's just the confidence in the economy is quite uncertain, because people are like, okay, we seem to be getting on stable footing economically here in the general G7 economies. When are we actually going to start seeing improvements in our life when it comes down to rent, when it comes down to food? And net, the expectation is that, well, maybe sometime during summer things will start to pick up, and going into the second half of the year, we'll actually start to see those improvements follow through. So it might be another 2-3 months of FOMO that comes at us with, oh man, we're gonna fall down another 500 points on the S&P and this and that. It's like, guys, 6,000 S&P this year is actually not out of the question at this point. If this recovery continues at the pace it's going at, and inflation does come down, and the Fed cuts rates, like the soft landing, or the no landing, rather, might actually occur. I mean, even if we do get some bad data that actually realizes itself, we're going to be in a soft landing scenario, and then the economic damage is going to be quite mitigated. You might have a 5-8% drawdown, worst case scenario, unless you have something really terrible happen economically. But until those things actually occur, all these bears are counting their P&L before it's realized. And it's throwing a lot of people off in their commentary. When I listen to people, it's throwing so many people off. So I'm a bit in a ranty mood the last couple of days, because it's just like, well, we can continue. We've set all of our expectations for the month and for the week, and now we're in the middle of the week. We're only at Tuesday, and we're done with planning for the freaking rest of the week here on a lot of these assets. And now it's more or less a matter of, well, do we need to update any of these expectations on any of these trades to accommodate for some of these movements? And I'm like, well, no, we kind of worked this out last week. last Friday we already set these expectations, and there's the timestamps things to show. When it comes down to cross pairs, that can be a more interesting play, at least in the FX space. The yens, don't get me wrong, the yen side of these yen pairs weakened, so there was a bit of risk on. But I don't know how long this risk on is going to last, because, well, guess what? You got BOJ coming around, and they'll hike, and they'll ease. I mean, I saw something interesting, which is actually one of the worst performing sectors right now in Japan is the bank sector, even though their yields are increasing, even though the Bank of Japan is tightening. I just found that interesting. We can go ahead and start checking out some commodities. Let's check out gold. Gold did pull back today. It hasn't recovered from this like a lot of assets have. But we set our expectation to, hey, reach this spot here at some point. We set our expectation to reach this spot here. This was the conservative spot. This is the aggressive spot. We're like, well, taking some off here does make sense, because guess what? We had some uncertainty going into CPI, just like everybody else. It's just a lot of people confused that uncertainty with things are going to go bad. Oh my God, things are going to go bad. And people are still conflating uncertainty with bearishness. Sorry, just because we have uncertainty doesn't mean we are going to be bearish, positioned bearishly. It just means, well, it can go either way. Once the data is actually realized and it prints and we can see it, then we'll make our decision. But net things are still going pretty good going into the event, and we hope it is good. And it turned out nominal. And even with a nominal CPI print, some people are still, over-exaggerating it, saying it was a hot print. So gold and commodities in general, actually, from here, still can have some more upside. Look, just because it's moved up close to $200 doesn't mean it has to go lower. Just because price has moved a lot over a period of time doesn't mean it has to go lower. And I don't necessarily see a terribly strong reason for this thing to be trading below 2100 by the end of the month, because when you go out this far, you're catching clouds at this point. You're going higher and higher and higher, and you're trying to grab onto something, and you're grabbing onto clouds, and they're going right through your fingers. And you never know when you're actually going to be able to grab onto something. It's the inverse of a falling knife. I mean, if we check this out on a weekly range, I mean, don't get me wrong, a lot of your lows for the week are also right around here, so it wouldn't frankly surprise me. But then again, seasonally, there's nothing really here. You can see it's a very flat looking distribution, no serious peaks. Wow, next week has some really good continuation. Odds 25% of lows are above the weekly central pivot. And a lot of your highs are up here. So maybe there's no new high this week, or maybe even next week on gold. Maybe this is the high for the month on gold. But we're in a scenario now where things can still run away. And the people who think that's not a possibility, don't get me wrong, I absolutely can be wrong. I already set my expectations ahead of time with these timestamps. It's just, hell, I might have to set my expectations to be even more bullish if these guys who are just sitting on the sidelines because they're uncertain continue to sit on the sidelines and make the ask side of the order book super thin because they're not actually selling because they don't have super high confidence we're actually going to go down, and everything else being nominal, improving over time. It's going to be an interesting time ahead here. And also, Russia came out today, said we support more cuts. They're talking with OPEC, potentially about more cuts too. So that kind of puts some more umph into future expectations for oil. This thing probably can go a bit higher on the week, I think. We set expectations for this thing to go a bit lower. So we got some down movement. These were just big bottom wicks that got butt up. So now we are probably going to have to change our expectation to be a bit more bullish going into the end of the week. So let's do that on oil, which is, it's probably going to be along these lines here. I can go ahead and do that. Blue. Let's go ahead and set this up. Close on the seasonal data. Yeah, so most of the time, seasonally and non-seasonally, most of the closes on oil are around here. And see, this is the 12th. All right, timestamped. We're good to go. So we've updated our expectation from way down here to up here to still the same target, but now from here, effectively. And don't get me wrong, OPEC can come out and say, we're not gonna cut anything, but sometime in the future we will consider more cuts. That's still changing future expectations. And that will add some support for oil in the future if they do something, say something along those lines as they hold their current production levels. Crypto, ETH, all this stuff holding up fairly well. Yeah, it sold into CPI and then rebounded a bit. I don't think this is gonna be the end of it here. I don't. I don't see this as being the end of the current rally on crypto. Just tell me why. Why would it be? If the answer is, oh, it's overbought, quote unquote. Guys, this thing goes parabolic. This thing can literally go parabolic. Bitcoin supply has an asymptote of 1 million, and we go there from 0 to 21 million, my man, on a logarithmic scale. And in economics, your supply and demand is inverse. And if you consider your demand as like a price, well, when you take the inverse of your supply, a logarithmic curve, guess what that does? That gives you your demand as an exponential curve. Theoretically, the target price for Bitcoin is infinity. It's infinity, technically. All these guys say, oh, Bitcoin price is like, we should hit $1 million, $10 million, $50 million. The math of how Bitcoin works is it's like an infinite money glitch. It's a form of hyper disinflationary money, exponentially disinflationary money. That's just how it works. And that's how I've been describing it for like the last 5 years to people. So when it comes down to price targets on crypto, it's just, yeah, pick a number, any number higher than the current price. And at some point in the future, you'll probably hit it, so long there's no EMP attacks, right? There's no global thermonuclear war, but even in that case, everything goes down to zero anyway. So, I mean, maybe gold and food go through the roof. I mean, what was it? Cocoa futures. You guys seen this? Cocoa futures are like an all-time high. This crazy thing. It's done better than Bitcoin. It's just gone totally parabolic. This is actually kind of what Bitcoin can do. I actually don't know why Cocoa has done this, but this is insane. Cocoa to 200% since last November. Like, crazy move in Cocoa there. Interesting little factoid of the day. Look at this. All the equity indices here on the watch list are positive. All the equities. Here's the Dow Jones. How about the Russell? The Russell is red, but this is just a nominally bearish day. This isn't like this or like a whole series of red days. This is still pretty good. This is still pretty all right. I look at these companies, they're doing pretty okay. A lot of companies are improving right now from worse positions. If you just focus on their current position, you're not looking at where they're going. The whole point of being a good trader is looking at the rate of change, the derivative of expectations, the rate of change of economic and business factors, because you want to catch the change when you're trading. And focusing on future expectations, future changes in expectations helps a lot when it comes down to this sort of stuff. Look, even Japan's doing all right. Man, oh man, oh man. Let's see here. Canada still not holding up all too well macroeconomically, so maybe there's some more positive drift here. But look, this was the month ahead expectation that I set at the end of February, on the last trading day of February. We did our month ahead expectation, and the expected closing price is where we're at right now. If Canada comes out with any more good information, this expectation could easily be exceeded. Here, let's look at our closing odds. So, yeah, once you start trading around there, it becomes more or less a guess. Oh, wow. Yeah. That's a risk. I think I was trying to split some hairs saying, yeah, if we get our move higher here and we reach a likely high, right, on the month, and then pull back and drift and drift and drift lower. Well, no, the kibosh was just put on this thing right away. And we went lower our expectations and said, we're going to even close this week even lower, which we did within a good margin of error. That negative drift now could still come in, and we could end up doing something along these lines. Like, get more dollar weakness and more risk on is a real possibility here going into the rest of March that a lot of people are just being blindsided on because of the amount of uncertainty that they currently have. Now, it's fine to be uncertain. It's perfectly okay to say, I'm uncertain about my future expectations and what I should be doing. It's actually extraordinarily important that you say that to yourself if you are going to be making any sort of decision. Because you want to know when your confidence is high and when your confidence is low. You don't want to be setting expectations and not understand the amount of confidence you have in those expectations in the first place. So it's okay to be uncertain and make contingency plans. That makes sense. However, it's another thing to just straight up confuse, oh, I'm uncertain about future expectations, with, because I'm uncertain, things must be bad right now. You should just say, I have a bearish expectation. I have a risk-off expectation, if that's actually the case, instead of saying you're uncertain. Because when you're saying you're uncertain, you're like, this can be a coin flip between a good or a bad outcome. That's what you're really saying when you're uncertain. You have a 50-50 odd of the good or the bad outcome. But then when you say, oh, because I have a 50-50 chance of being right or wrong, I'm going to go ahead and start trading the bad expectation. I mean, maybe that is your preferred bias. But then you have to have serious contingencies on, well, because you're uncertain, where are the spots where you get out? And even when when most people set trading expectations, it's like, okay, I'm bullish. Where am I wrong? What are my expectations if the data surprises against me? When do I update my expectations to go in the direction the market's actually going with the data we actually have available? And being reactive to that, that's the strike, is important. So I'm going to put this in here for now. I'm actually, oh man, check that out. You have a peak right there for your monthly lows. Yeesh. I'm actually kind of interested in looking at next week's odds early today here on this particular pair here. Let's look at next week's seasonal odds on the low side and see if next week seasonally is particularly bearish or not. No, it's more nominally range bound. You usually don't get this sort of crazy move next week. You don't. But that's on the assumption that things are behaving seasonally. So if you have a strong trend, if you have strong momentum that continues, the seasonal expectations don't hold up, which is why we have indicators like this that say, hey, if you look back over all the data you have available and all the different economic regimes that are mean reverting, high momentum, all this stuff, just include all the charts data, this is generally what the distribution of lows look like for a given week. So yeah, maybe 134 here on dollar CAD is in the cards. And then guess what that lines up roughly with this peak here on the month that I'm checking out. And then you go up like that into the close. Go ahead and look at some closing odds usually for the month of March. You could end up with something. You could end up with something along those lines, maybe. Now, I'm drawing this for illustrative purposes. That, hey, this sort of risk can be here. But I'm not going to put my expectation on this because guess what? The Canadian economy ain't doing so hot right now. And the US economy is still, rate of change wise, outperforming the Canadian economy. I don't know if this is a smart expectation or not. So I don't want to set this as my expectation. I want to see better data come out of Canada before I absolutely say this thing's absolutely going to go lower. Next week, we're getting flash PMIs out of Europe. And the flash PMIs, I mean, there was the monthly PMI bulletin that just came out like in the last 24 hours. The guys who actually deliver and do the analysis on and calculate the PMI indices, they said, well, things are improving. And based on the prior data we got, things really improved quite well. And based on the information we've collected since then, things still look like they're continue to do well. So come next Thursday's flash PMIs, I'd still expect continued improvement in the PMIs. And the flash PMIs are pretty damn important. So I'm more in line with seeing maybe more upside on Europe because their rate of change, their economic growth is on pace either with the US or it's improving from a better absolute worse location. I mean, for example, take the UK. The UK is growing from a particularly bad spot right now. Every person who's doing commentary on the UK is like, well, economic data in the UK right now is on an absolute spot, in a really bad spot. When you just look at the data front up, it doesn't look all that great. But the future expectations for the UK is that that data will improve. So maybe right now, Canada and the UK aren't going to do so hot. But who's you to judge and say we can't do that in April or May when we have some more data to actually prove whether or not things are actually improving or not? So it's about, don't be too judgy. And I mean, hell, even look at this on this pound dollar. If I can pull it up again, I set an expectation of, hey, if this CPI comes out nominal, we'll probably keep going higher. This thing can really run away. That expectation is just flat out wrong. And this was an expectation from last Friday. It's okay to set expectations and be wrong. It's not okay to say, oh, I'm uncertain, therefore, like, have a reason for your expectations. So you're not trading such a general idea that it doesn't even make sense to follow why you were wrong or why you were right. Like, again, it's okay to be wrong on your expectations. It's not okay to flip-flop and set expectations that are so general that you can just come up with like any excuse to be right or to not have your ego personally hit or whatever. Like, I want to see more data out of Canada, and I didn't set an expectation for this week based on last week's data here for CAD, so I'm just going to wait for a bit more data before I feel comfortable setting an expectation for this one. There's a probability gap every day on NQ on the 15-minute. Let's see here. Oh yeah, I see you're probably looking at this spot right around here, right? From here, once you start trading in there, the odds are pretty low, so you're expecting to go to the next highest spot. Yeah, I've seen it fill every time prices entered it. Could you take a look and tell me? I mean, yeah, generally speaking, these low probability spots, being that there's a low probability of finding your high for a given day here. Now, this might not be, an insane amount of money, right? Today's move was about, 44 points. But hell, over the long run, buying once you're in a low probability spot, expecting it to go to the next highest spot is something that I've done over, the last 3 or 4 years. And that's frankly how a lot of automated systems that use quantitative analysis algorithmically trade. They'll go ahead and see what's the most likely outcome. That the current spot we're in is, quote unquote, unstable, for lack of a better word. And that the next most likely spot is probably somewhere higher. Now, they might not do it on a 15-minute. I'd probably pull up a 2-hour, see if the thing still exists there. And yeah, it still exists there. But now when you go to higher time frames, it incorporates a bit more data. So now your gap's kind of in that spot. You go a bit higher in your frame, and now the gap is so small, it gets kind of contained by just the sheer size of the bins when you go higher in your time frame, because the size of these bins will increase versus when you go to a 15-minute, the size of these bins is like a few points. Yeah, the size of this bin is 6.5 points. The size of this bin on a full is 14.75 points. So yeah, for intraday trading, for small moves, sure, I can see that working out. But scalping's just not my style, doing these smaller chart trades, because you're just constantly having to watch the chart, right? That's all. Some people are fine with this. You know, there's a lot of people who essentially the whole lives revolve around waking up at 8:30 or being at the market at 8:30 a.m. Eastern and trading the first 30 minutes of the day. And this would be, you know, something that might just be right up their alley, right? Yeah, absolutely, my man. Yeah, exactly. 44 points is perfectly fine for you. Again, it's just there's just different approaches. Some people just want to look at charts for 30 minutes, see a good opportunity, study something that's set up, and go for that. You know, most of my stuff is I like to try and be in a trade for like maybe a day or two, and I know enough about when I need to get out or get in or change my expectations because I read and follow a lot of stuff. Try to stay very high information. But when it comes down to scalping, it's not my cup of tea, but the indicator provides. The indicator will show it to you. If the asset also has this sort of scenario. I mean, maybe this doesn't exist on the ES, for example. I mean, it's sort of there on the ES, but the probabilities in this spot are a bit higher, right? So it's a bit less likely that it goes exactly to the spot. However, now you would have had the way and it still would have hit that spot. And then it would have hit this spot. Again, let's see how much time, if I bring up this info label here. This uses 89 trading days worth of data. And for people who look at it and they're like, 89 trading days is not a lot of data to crunch your stats. Well, again, when you're just using the last 89 days of data, all you're doing is biasing the statistics just to focus on the most recent 3 months of data. That's it. There's a lot of guys who do high frequency trading and they only use the last couple of months of data, and that's totally fine for them. However, you go ahead and do the same thing. How much data is in here? 1,363 trading days is in here. So you get a different distribution. Different data. It's just based off how much data you can go back in history on intraday charts. That's all. Trading view will truncate the amount of historical data that's loaded based off the chart time frame you load. So different data gets loaded into the indicator when it looks all the way back into history that's provided. So, you know, different strokes for different folks. And we did set a bullish expectation here on the month. We did say, hey, up here is nominal, and up here is where you start getting your extraneous bullish momentum coming through. And we're going to have to come through and see if this stuff actually holds and the dollar actually gets weaker and the economic data actually prints good or nominal. One thing that's kind of like a bit of cognitive dissonance is that when people, for example, are looking at this CPI and you ask them, well, what are the how does this change things, right? Because this CPI, quote unquote, was hot, right? It's like, okay, this was a hot CPI. How is that going to impact the Fed? How is this going to change what the Fed says next week when they meet? How is it going to update their dot plots or their commentary? Outside of they may position their commentary to be just a bit more hawkish, this doesn't change the future rate path. Like when you go and you look at the rates markets, this hasn't changed or pushed forward the first rate cut expectations. It's kind of solidified right now that the Bank of Canada is going to cut in June. The ECB is going to cut in June. The Fed is going to cut in June, and then the RBNZ sometime maybe in September. I think the RBNZ, some people are also saying September. People are saying that the second rate hike out of the BOJ is also going to be in September. So September later this year is also going to be a big month. So yeah, it's really just, what about, how much do you know about the world? How much do you know about future expectations? And what information are you getting right now that changes those things? Your views on the world or your views on future expectations. Geopolitical news and new wars and stuff or new stimulus packages can change your views about the world because people will be spending money in different ways with wars. Some people, start getting involved in wars. The kind of culture of a wartime society changes a bit. And with future expectations, oh, this new bit of economic data just came out from CPI. How does that change what the FOMC is going to do in the future? Well, yeah, apparently this hot CPI didn't change anything. It's a huge nothing burger for future expectations. Huge nothing burger for future expectations is the matter. Now, if the next CPI, in April, reporting the March data, is actually hot, or rather exactly the same, still sticky, that's going to start to make some people concerned about potential upside risks, unless you get some smart guys who are looking at the data and say, well, yeah, it's still sticky, but still we expect this thing to go down in the future because we don't see anything that can create upside surprises yet. So yeah, CPI can stay sticky during this report and the next report and the report after that. But ultimately, the thing that will determine the path of a lot of these prices is future expectations. And if some new bit of information comes in and isn't obviously bearish on expectations, I don't see a super huge reason why some people have some incredibly bearish expectations here going into the end of March until it actually shows itself. It's fine to have uncertainty about the economic events and whether or not they'll actually surprise bearish. It's just a matter of, don't count your P&L before it's realized. Don't try, hell, you can have a good economic model that might tell you, oh, this economic event is going to report this, or this economic report is going to report that. It's fine. It's another thing to help you do forecasts and set your own future expectations. That's fine. And in that case, if something says it's going to print, let's say next CPI prints month over month 0.6%, well, that would actually be some bad news. That would definitely make the dollar go high, and that'd definitely be risk off because that's a re-acceleration in inflation. And the key word there is re-acceleration. That's a concern. That's a rate of change increase. And the last thing you want is bad data getting more bad. And I don't see that currently. People who run a lot of businesses don't see that. Everyone's just kind of upset with currently the absolute value of where things are at right now with inflation and some standards of living, which need to be resolved for people's quality of life and happiness to overall increase. But the expectation is that over time, those things will come, especially towards the second half of this year. It's just, again, don't get so bearish until the bearish thing actually happens. Oh, man. I mean, it's another sort of ranty video. I've gone over some charts, and most of my expectations from last week are essentially the same. And I just hope maybe over the next couple of days we get some information so I can start setting expectations for next week. That's really what I'm looking forward to at this point, is figuring out what the outlooks are for next week, because we have some major events next week, starting the plan for next week, and getting ahead of the game so that I'm not constantly worrying about what I should be doing or how I should react to some new information. And with that all said, I'll go ahead and I'll see you guys tomorrow. I'll go ahead and end the stream there. Been almost an hour now. If you watched this far and you're still here, feel free to leave a like and all that. And I'll see you in the Discord server if you're around. Alrighty, you guys. In a bit.